When Wall Street pulls the plug, it doesn't whisper, it slams the door. And that's exactly what happened when investors stripped $180 billion from Elon Musk's fortune. The warning signs were stacking up: relentless price cuts, growing competition from China, and even echoes of Trump's tariffs shaking up global supply chains. But none of it seemed to matter until it all did. The red flags were waving long before the fall. One misstep led to another, and before anyone realized it, confidence had quietly unraveled. Behind the headlines and boardroom decisions were moments of doubt, risk, and ego. So how did Elon Musk go from being the world's richest man to the face of a $180 billion crash? Let's trace the path, decision by decision, red flag by red flag. Wall Street's shift in support. Elon Musk was Wall Street's golden boy. Big investors and stock experts couldn't get enough of him or Tesla. They saw him as a genius who was changing the car industry forever. But things have changed dramatically. In recent months, many of Wall Street's biggest names have turned their backs on Musk. It started with small whispers of doubt, but now it's turned into a loud chorus of criticism. Major investment banks that once praised Tesla are now telling their clients to be careful or even sell their shares. Goldman Sachs, one of the most respected investment banks, downgraded Tesla's stock from buy to hold, basically telling investors not to expect the stock to go up much anymore. Morgan Stanley, another huge bank, lowered their price target for Tesla shares, meaning they think the stock is worth less than they used to believe. Bank of America went even further, giving Tesla a sell rating, the investment world's way of saying get out while you can. Their analysts pointed to growing competition in the electric car market and Musk's distractions with other companies like Twitter, now X, as reasons for concern. Big investment funds have been selling off their Tesla shares too. T. Rowe Price, which once owned more than 10% of Tesla, has sold almost all of its shares. Even ARK Invest, run by Cathie Wood, who was one of Musk's biggest supporters, has reduced their Tesla holdings. The numbers tell the story clearly. In just one quarter, institutional investors, the big Wall Street firms, reduced their ownership of Tesla by nearly 5%. That might not sound like much, but it represents billions of dollars flowing out of the company. Why did Wall Street change its mind? There are several reasons. First, Musk's purchase of Twitter for $44 billion worried investors who thought he was spreading himself too thin and using too much of his Tesla shares as collateral for loans. Second, Musk's public behavior became more unpredictable. His controversial tweets, political statements, and public feuds made investors nervous. Wall Street likes predictability, and Musk was becoming anything but predictable. Third, Tesla's growth has slowed down. After years of explosive sales increases, the company's growth rate has dropped. Meanwhile, competitors like Ford, GM, Volkswagen, and Chinese companies like BYD are catching up with their own electric vehicles. Wall Street analysts have also pointed to Tesla's shrinking profit margins. The company has cut prices several times to boost sales, which means they make less money on each car they sell. The shift in Wall Street sentiment shows up in analyst reports too. The average price target for Tesla shares has dropped by over 30% in the past year, and the number of analysts recommending buying the stock has fallen from 22 to just 14. Perhaps most telling is what investors are saying privately. At investment conferences and in private meetings, the buzz around Tesla has changed from excitement to concern. One portfolio manager at a major fund was quoted saying, "Musk used to be Tesla's biggest asset. Now he might be its biggest liability." This dramatic change in how Wall Street views Musk and Tesla has contributed significantly to the $180 billion drop in Musk's personal wealth, showing just how quickly fortunes can change when investor sentiment shifts. And behind that reversal, powerful forces were already in motion. Global trade tensions, tariff wars, and shifting policies were tightening the screws long before the market reacted. To understand how it all came crashing down, we need to start with the outside pressure that quietly reshaped the battlefield. Influence of tariffs and trade policies. When countries buy and sell things with each other, their governments sometimes add extra costs called tariffs. Think of tariffs like a special tax on products coming from other countries. These tariffs can make things more expensive and change how businesses operate. For Tesla and Elon Musk, tariffs became a big headache. Donald Trump, when he was president, started what many called a trade war with China. He put high tariffs on Chinese goods coming into America, and China hit back with their own tariffs on American products. This created a problem for Tesla because they sell many cars in China and also build some there. When China put tariffs on American cars, Tesla's vehicles suddenly cost much more for Chinese customers. At the same time, Tesla was trying to grow in China, which is the world's biggest market for electric cars. Later, when Joe Biden became president, some people thought these trade fights might calm down, but many tariffs stayed in place, and now Trump is talking about bringing back even bigger tariffs if he becomes president again. He's mentioned putting a 60% tariff on all Chinese goods and maybe 10% on products from everywhere else. This worries Tesla investors because the company depends on global trade. Tesla gets parts from all over the world, sells cars internationally, and has factories in different countries. Any increase in tariffs could mean higher costs for parts Tesla needs to build cars, more expensive Tesla cars in other countries, fewer people buying Teslas because of higher prices, lower profits for the company. The tariff situation gets even more complicated because Tesla has a factory in Shanghai, China. This factory makes cars for Chinese customers and also ships them to other countries in Asia and Europe. If new tariffs make it harder to move cars between countries, Tesla might have to change how they run their business. All these worries about tariffs and trade policies made investors nervous about Tesla's future. When investors get nervous, they often sell their stocks, which is partly why Tesla's stock price dropped so much. As the company's biggest shareholder, Elon Musk felt this drop directly in his net worth. Making things worse, other countries are also changing their trade rules for electric vehicles. Europe and some Asian countries have their own tariffs and rules that affect Tesla. Some countries give special benefits to electric cars made locally, but not to imported ones like Tesla's. The timing couldn't be worse for Tesla, just as competition in the electric car market is getting tougher, especially from Chinese companies making cheaper cars. These trade policies are making it harder for Tesla to compete globally. For Musk, who once had a friendly relationship with Trump and served on his business advisory council, the situation is tricky. He needs stable, predictable trade policies to run his global business. But politics and international tensions keep changing the rules of the game. As trade pressures mounted, Musk found himself navigating more than just market forces. He was wading into political waters, and that's where things got even more complicated. Political ties and public perception. Elon Musk's recent friendship with former President Donald Trump has changed how many people see him. This relationship has affected not just what regular people think about Musk, but also how investors feel about putting money into his companies. For years, Musk was seen as someone who cared about the environment. His electric car company Tesla was all about fighting climate change by getting people to drive cars that don't use gas. Many people who bought Tesla cars or invested in the company did so because they believed in this mission. But things started to shift when Musk began openly supporting Trump. Trump has often said he doesn't believe climate change is a serious problem and pulled the United States out of climate agreements during his presidency. This created a disconnect. How could someone who built a company to fight climate change support a politician who doesn't see it as a big deal? This change confused many Tesla customers and investors. Some Tesla owners even posted videos of themselves getting rid of their cars because they felt betrayed. One customer said, "I bought a Tesla because I thought I was supporting a green future, not Trump's policies." Investors started worrying too. Wall Street analysts began questioning if Musk was still focused on Tesla or if he was getting distracted by politics. When Musk appeared at Trump rallies and made political statements on social media, Tesla's stock often dropped the next day. The numbers tell the story clearly. After Musk endorsed Trump in July, Tesla's stock fell by nearly 12% in just 1 week. Investment firms like Morgan Stanley and Goldman Sachs lowered their price targets for Tesla, saying that political risk was now a factor in their calculations. It wasn't just about who Musk supported, but how much time he seemed to be spending on politics instead of running his companies. Every hour Musk spent campaigning was an hour not spent solving Tesla's production problems or developing new products. Social media made everything more intense. When Musk posted political opinions on X, millions of people saw them instantly. This created immediate reactions in the stock market. Some days, a single post from Musk would cause Tesla to lose billions in market value. Customer surveys showed the impact too. A poll by Consumer Reports found that Tesla's brand reputation dropped 24 points among Democratic voters, but only rose 8 points among Republican voters, meaning the political move cost more support than it gained. Big investors like pension funds also started to worry. CalPERS, which manages retirement money for California public employees, publicly questioned whether Musk's political activities were good for Tesla shareholders. The situation created a challenging cycle. As more investors sold Tesla stock because of concerns about Musk's political activities, the stock price fell further, which made even more investors nervous. For middle school students, this shows an important lesson about business. When you're the face of a company, your personal choices and who you associate with can affect how people see your business. It also shows how in today's connected world, the line between business and politics isn't always clear, and crossing that line can have real financial consequences. Impact on Musk's other ventures. Elon Musk doesn't just run Tesla, he's also in charge of several other big companies, and the problems at Tesla are starting to affect these other businesses too. SpaceX, Musk's rocket company, has been one of his biggest success stories. The company sends astronauts to the International Space Station and is working on rockets to eventually take people to Mars. Until recently, SpaceX seemed untouched by Tesla's troubles, but now things are changing. As Musk's wealth has dropped by $180 billion, he has less money to put into SpaceX. This matters because space exploration is super expensive. Each rocket launch costs millions of dollars, and developing new spacecraft costs billions. SpaceX was planning to send its massive Starship rocket to Mars in the coming years, but these plans might slow down if Musk can't invest as much of his own money. Some SpaceX employees are also worried about Musk being distracted. One engineer who didn't want to be named said, "We used to see Elon at the factory all the time, testing rockets and solving problems. Now he's on social media or at political events instead." X, formerly known as Twitter, is facing even bigger problems. After Musk bought Twitter for $44 billion in 2022, he renamed it X and made many changes. He fired most of the staff and changed how the site works, but advertisers didn't like some of these changes or Musk's political posts, and many stopped buying ads on X. This has created a money problem for X. The company needs advertising dollars to survive, but those dollars are disappearing. Reports show that X's value has dropped from $44 billion to around $19 billion, less than half what Musk paid for it. This means Musk has lost over $25 billion just on this one company. The Boring Company, which Musk created to dig tunnels for transportation, has also slowed down its projects. The company had big plans to build tunnel systems in Las Vegas, Los Angeles, and other cities, but many of these projects are behind schedule or have been scaled back. Neuralink, Musk's brain-computer interface company, is still moving forward with its work, but at a slower pace than Musk originally promised. The company recently put its first brain implant in a human patient, which was a big step, but investors are questioning whether Musk can give the company enough attention with all his other problems. All these companies are connected through Musk himself. When he's stressed about Tesla's stock price or spending time on political activities, he has less time and energy for his other ventures. And as his wealth shrinks, he has less money to support these companies when they need it. Some business experts think Musk might need to sell parts of his companies or find new investors to keep everything running smoothly. Others believe he should step back from day-to-day management and let other people run some of his businesses. What's clear is that the troubles at Tesla aren't staying at Tesla. They're spreading throughout Musk's entire business empire, creating a domino effect that could change the future of space travel, social media, and transportation. Future implications for Elon Musk and Tesla. Let's look ahead at what might happen with Elon Musk and Tesla. Right now, things are pretty rocky. Tesla's stock has dropped a lot, and many Wall Street investors aren't happy. But what could the future hold? Tesla might bounce back. Companies go through tough times, and Tesla has recovered before. If the company starts selling more cars again, or releases exciting new products like the Cybertruck that people actually want to buy, investors might change their minds. Tesla could focus on making their cars more affordable for regular people instead of just luxury vehicles. vehicles. This would help them sell more cars and make more money. Elon Musk could also change how he acts. Many investors are upset because he spends so much time on X and other companies instead of focusing on Tesla. If he starts paying more attention to Tesla again and stops saying controversial things online, Wall Street might start trusting him again. Another possibility is that Tesla could become more than just a car company. They already make batteries and solar panels. They could grow these parts of their business to become an energy company that also happens to make cars. This might open up new ways to make money. But there are also some not so good possibilities. If Tesla keeps losing money and Musk keeps dividing his attention between too many companies, things could get worse. More investors might sell their Tesla stock, making the price drop even more. Tesla might have to lay off more workers or close some factories. Competition is another big challenge. Almost every car company is now making electric vehicles. Some, like Chinese companies BYD and NIO, are making cheaper electric cars that many people can afford. If Tesla can't keep up, they might lose their spot as the leader in electric cars. Musk's other companies could also affect Tesla's future. If SpaceX continues to do well with rocket launches and satellite internet, Musk might spend even more time there. Or if X, Twitter, keeps losing advertisers and money, he might have to sell more Tesla stock to cover those losses. The relationship between Musk and his investors is important too. Some big investors are already upset and have sold their Tesla shares. If more follow, it could be hard for Tesla to raise money for new factories or research. One wild card is Tesla's self-driving technology. If they can actually make cars that drive themselves safely, it could be a game changer. But if they keep promising this technology and don't deliver, people might stop believing in Tesla's future. What happens next depends on many things: Musk's choices, how well Tesla's products sell, what competitors do, and whether Wall Street decides to give Musk another chance. The next year or two will be crucial in determining if Tesla can turn things around, or if this $180 billion crash is just the beginning of bigger problems.